All right, so let's begin the show today with the topic about whether you should be investing in your fixed deposit or not. Considering that we have not seen any interest rate cut so far, is it time for you to lock in money in your fixed deposit as an investment option? Should you be considering it? Looking at the high rates now, what's the likely scenario for someone who wants to park their money in fixed income, especially for a short term? Let's look into this, and I have with me Arnav Pandya, founder Moneyeduschool. Arnav, good evening and welcome to the show. So can we say this is like the last tranche of party for whoever wants to invest in fixed deposit and take the benefit of higher interest rates right now?
Good evening, Kavita. So, according to me, the kind of rates which you are seeing right now, I don't expect it to rise much, except maybe for some specific durations if a certain bank wants to raise it. But definitely, looking at the horizon, it is very clear that rates are going to decline from the levels which are seen currently. Now, whether that decline comes after 4 months, 5 months, 6 months, that is an open question. But it is certain that the decline will come over the next 1 year. And these rates which you see today might be one of the highest in recent times that you will witness.
All right, Arnav. So now, should we also look in for a longer term parking in fixed deposit? We will also talk about debt mutual funds, where maybe you can play a role of a long term investment horizon. But then specifically talking about fixed deposit, can we look at 1 to 3 years parking time? Will that be good enough?
So, one is that every investor needs to look at the time period after which they need the money. And that will primarily determine the time period for the fixed deposit. If they select the fixed deposit as an avenue to park some of their funds, that they will select. Now, if you look at the scenario currently, for most banks, the highest rates which they offer, and these range for most scheduled commercial banks between 7 and 7.5%. So, for them, the highest rates at the moment are in the 1 to 3 year time bracket at different points of time for different banks. So, if you have that kind of time horizon and if you are going to go with a fixed deposit, then obviously locking into these rates for this specific time period is a good strategy, because you know right at this moment of time that, say for example, you invested for 2 or 2.5 years, then for this entire time period you are locking in the rates right now, and chances are that if you look at a shorter time horizon and then try and reinvest that amount, then chances are that when the reinvestment time comes after, say, a year or so, you will actually experience lower rates than what you are experiencing right now. So the smarter strategy would be that if you have this kind of time horizon, lock into these rates which you are available at the current point of time, so that you do not have any worry or a reinvestment risk coming up for that entire time duration.
All right. So, looking at the current scenario, fixed deposit rates are definitely attractive, and one should be taking advantage of it as well, as you explained. But then, how likely is the scenario of deposit rates going down? And also, before that, could you also explain if the entire transition of rate hike in terms of deposits has been given by the banks to the customer? Has it been passed on? Unlike how we see an immediate transmission of interest rate hike when it comes to loans. Obviously, it is linked to a benchmark and there is a resetting period. But has the same been done as far as deposits are concerned?
Yes, so if you look at this entire cycle, when the rates started rising, in both in terms of the overall economy, in terms of the yields, in terms of the RBI hiking rates, and what the banks have given, at least most of, or rather virtually all of the details have been passed on to the consumer. So what the consumer saw, say a couple of years back when the rates were in the range of 5.5%, now they have seen at least a 200 basis point rise in terms of these rates. So that rate hike has been passed on. What is happening at the current moment is that there is a liquidity crisis in the debt market in the sense that liquidity is short and banks are finding it very, very difficult to raise deposits while their loan books are still showing a good and a strong rise. So banks still need a lot of deposits, and due to that, they are still forced to raise their rates for several specific time horizons because the bank want to get money for the time period for which they are lending. So they do not want an asset liability mismatch. And this plus the fact that deposits are not coming in as per their requirement, they are still forced to raise interest rates in specific time buckets. And that is where you see that even today, some banks might be raising rates a bit. But after this entire period is over, or if the liquidity eases, you will find that the banks will then slowly start cutting rates on an overall basis.
All right. Now, also let's look at the scenario of bond yields. Looking at the way inflation data has come for us and even for the US, rate cut there's still time for it for the central banks to act on it. But then, what about bond yields? Have they already factored this in that higher interest rates are there for some more time, or the bond yields have gone beyond their expectations?
So if you look at Indian bond yields, there are two main factors at play here. One is that inflation, even though it has moderated a bit, it is still above 5%. So there is still a bit of risk element involved because some disruption either on the food side or on the fuel side can again see inflation spike a bit. So if that happens, bond yields will still harden for some point of time. The second point, which bond yields are also looking at very closely, is the kind of situation in the debt market where the government has signaled, at least in the vote on account, that they are going to borrow less from the market. And that is a good sign. Now, the moment this actually translates into actual lower borrowing, and the second part is that if inflation actually comes down, that is the time period when you will find that yields will start coming down. But till there is clarity on both these fronts, I at least expect that the bond yields will move in within a very narrow range, but they will still remain above 7%. Good news on either of these fronts or both of these fronts will be the catalyst for yields for the 10-year benchmark yield to go below 7%. So till then, expect yields to remain firm because there is still a lot of uncertainty. And as you can see, yesterday, for example, the way the US inflation came in, which was slightly higher than expected, I mean, that at least puts the rate cut scenario off for a certain period of time. And similarly, I mean, in India, with inflation not breaking decisively on the lower side, you will find that RBI will still continue its policy of holding rates till the time the situation is slightly clearer.
All right. So, looking at the scenario right now, can one also adopt a strategy of a staggered fixed deposit, or maybe renewing the same fixed deposit for one more year? As in, can they just continue the fixed deposit period one by one?
So, I mean, if you have a longer time horizon, the idea would be that you at least now, whenever your old fixed deposit matures, you go in for that entire longer time period horizon. Because most likely, what is going to happen is that if you renew it for a year, and if that is your strategy, that you keep renewing the fixed deposits with mature for one year more year. After a year, you are definitely or you're most likely to see rates which are lower. So at that point, you will find that there is the challenge of reinvesting that amount. And by that time, it could also be that then switching to a debt fund would also might not be the best alternative at that point because of the fact that the debt funds might have already seen a lot of the gains on the capital gains front come in by that point of time because if yields start dropping, that is when the longer duration bonds will see a higher gain coming into their portfolios.
All right. So for a longer term, if you want to park in money, you can do it through debt funds. Is that the right strategy right now to do?
Yes, so for a longer term, uh, the longer duration debt funds, you can slowly start investing into them, because what will happen is that when rates actually come down, these are the ones which will see the highest gains coming into that. So the question now is as to when the rates will start getting cut, or when will they start coming down. So there could still be quite some period of time, because say if RBI and the market thinks that these kind of movements in the rates on the lower side will come after 6 7 months, then for those 6 7 months you will not see any great uh, extra returns coming in for these kind of funds. But the idea should be that when rates are coming down, you are into the long duration bond funds, so that your gains are relatively higher.
All right. So currently, if you're someone who's looking to park in money in fixed deposit, it's the right time for you. Maybe you can look at a shorter term. But if you want to play a long-term time horizon as far as your fixed income investment is concerned, you can really consider. You can look at a debt mutual funds. And with that, thank you so much, Anna, for being on the show and helping our viewers with their investment strategy in fixed deposits. Thank you. Time for a quick break, but then post that we'll be taking our viewer queries on the show. And just in case you are watching us live and want to send across your questions, you can do that via WhatsApp number. And you can also send across your questions on our email ID, because we pick up questions from here and present it to our guests and do your live financial planning. So more of viewer queries after this break.